There is no income limit on Roth conversions. None. Zero. You could earn $1 million a year, and the IRS will still let you move money from your traditional IRA into a Roth. Most people don't know that. But here's the part that really matters. A married couple in 2026 with nothing but Social Security income could convert $50,000 to a Roth and pay an effective tax rate of just 5.2%. That's less than a nickel on every dollar. And once that money is in a Roth, it grows tax-free for the rest of your life. By the end of this video, you'll understand exactly how Roth conversions work, who they're best for, and the specific 2026 tax brackets and income thresholds you need to plan around. You'll also learn the hidden Medicare trap that catches thousands of retirees off guard every year, and the 3 strategies that tilt the math in your favor. Before we get into the numbers, a quick note. This content is for educational purposes only and should not be considered individual financial guidance. Everyone's situation is different. Please consult with qualified financial professionals before making investment decisions. Let's start with the basics. A Roth conversion is when you move money from a traditional IRA or a traditional 401k that's been rolled over into a Roth IRA. The IRS says this clearly in their retirement plans FAQ. Regardless of your adjusted gross income, you may convert from a traditional IRA to a Roth. There is no income cap. Anyone can do it. But there's a catch. When you convert, the amount you move gets added to your taxable income for that year. So if you convert $50,000, the IRS treats that $50,000 as income on top of whatever else you earned. You'll owe income tax on it at your marginal rate. And as of January 1st, 2018, you cannot undo a Roth conversion. The Tax Cuts and Jobs Act eliminated what was called recharacterization for conversions. That means once the money moves, there's no take back. So you need to plan this carefully before you pull the trigger. Now here's what makes 2026 a uniquely interesting year for Roth conversions. The One Big Beautiful Bill, signed into law on July 4th, 2025, made the Tax Cuts and Jobs Act tax rates permanent. That means the 7 brackets of 10, 12, 22, 24, 32, 35, and 37% will continue indefinitely. They are not going away. Before this law passed, those lower rates were set to expire after 2025 and revert to the higher pre-2018 levels. That uncertainty is now gone. But there's a bonus. The One Big Beautiful Bill also introduced a temporary additional deduction of $6,000 for taxpayers age 65 and older. This deduction is available for tax years 2025 through 2028, and it creates extra room in the lower tax brackets for Roth conversions. Let's put real numbers on this. For 2026, the standard deduction is $32,200 for married filing jointly. If both spouses are 65 or older, they also get the new $6,000 senior deduction each. That's $12,000 of additional deductions. So the effective deduction for a married couple over 65 is $44,200. Now here's where the magic happens. The 2026 federal tax brackets for married filing jointly start at 10% on income up to $24,800, then 12% up to $100,800, then 22% up to $211,400. The brackets keep going up from there, but for most retirees, the sweet spot is filling up that 10 and 12% space. Let's walk through a real example. A married couple with $40,000 per year in Social Security. About 50% of that is taxable, so $20,000 of taxable Social Security income. Their adjusted gross income before any conversion is $20,000. After subtracting their $44,200 effective deduction, their taxable income is zero. They are starting from zero. Now they convert $50,000 from their traditional IRA to a Roth. Their adjusted gross income becomes $70,000. After the $44,200 deduction, their taxable income is $25,800. The tax on that, $24,800 at 10%, that's $2,480, plus $1,000 at 12%, that's $120. Total tax, $2,600 on a $50,000 conversion. That's an effective rate of 5.2%. But here's what most people miss about Roth conversions. The tax you pay today is only half the equation. You also need to think about what happens to your Medicare premiums. This is the RMA trap, and it catches more retirees than you'd expect. RMA stands for Income-Related Monthly Adjustment Amount. It's the extra amount Medicare charges you if your income is above certain thresholds. In 2026, the standard monthly premium for Medicare Part B is $202.90. But if your modified adjusted gross income is above $109,000 as an individual or $218,000 filing jointly, you pay a surcharge on top of that. And at the highest bracket, $500,000 individual or $750,000 joint, your Part B premium rises to $689.90 per month. That's according to the 2026 CMS Medicare fact sheet. Here's the kicker. IRMA is based on your income from 2 years prior, so a large Roth conversion in 2026 could spike your Medicare premiums in 2028. Let's say you're a single filer and your conversion pushes your income from $100,000 to $200,000. Your Part B premium jumps from $202.90 to $527.50 per month. That's an additional $3,895.20 per year in Medicare surcharges alone. This is why you cannot just blindly convert as much as possible. You need to know exactly where the IRMA thresholds are and convert up to them, not over them. Many financial professionals call this filling the bracket, converting just enough to use up the space in a lower tax bracket without tipping into the next IRMA tier. And there's another trap hiding in your conversion. If you have both deductible and non-deductible contributions sitting in your traditional IRAs, you cannot choose to convert only the non-deductible portion. The IRS uses what's called the pro rata rule. Every dollar you convert is treated as a proportional mix of taxable and non-taxable money based on the ratio across all of your traditional IRAs. This is reported on Form 8606. So, if 80% of your total traditional IRA balance came from deductible contributions, then 80% of any conversion is taxable, no matter which account you technically convert from. So when does a Roth conversion actually make sense? The traditional rule of thumb says you should only convert if you expect to be in a higher tax bracket in retirement. But research from Vanguard in 2025 challenges that idea. Vanguard's break-even tax rate method, they call it BETR, shows that a Roth conversion can be favorable for far more investors than that simple rule of thumb would suggest. Vanguard identified 3 strategies that lower the break-even tax rate and make conversions more favorable. First, pay the conversion taxes from a taxable account rather than the IRA itself. Second, extend the investment time horizon. The longer the money stays in the Roth, the more the tax-free growth compounds. Third, make backdoor Roth contributions. That's when you contribute to a non-deductible traditional IRA and then immediately convert it to a Roth. Here's the window that matters most. Fidelity calls it the retirement income valley, the gap between when you retire and when required, minimum distributions begin at age 73. During those years, your taxable income is often at its lowest. Social Security might not have started yet. You're no longer drawing a paycheck. And required minimum distributions, those are the forced annual withdrawals the IRS requires from traditional retirement accounts, haven't kicked in. This is the prime window for Roth conversions. Your tax rate may never be this low again. Under Secure Act 2.0, the RMD starting age is 73 for those born between 1951 and 1959. It increases to 75 for those born in 1960 or later starting in 2033. So the conversion window could be 10 years or more for some retirees. And here's a number that should make you pay attention. According to Fidelity's Q4 2025 retirement analysis, the average 401k balance for baby boomers aged 61 to 88 is $249,300. The average IRA balance for the same group is $257,002. That's a combined average of $506,302 in tax-deferred accounts. Every dollar of that will eventually be taxed, either through conversions at a rate you choose or through required minimum distributions at a rate the IRS chooses for you. Let's look at what a conversion ladder could do for a couple with $500,000 in a traditional IRA. Converting $50,000 per year over 10 years with Social Security as their only other income, each year's conversion is taxed at roughly 5.2%. Total tax over the decade, approximately $26,000. The result, $500,000 in a tax-free Roth by year 10. Compare that to leaving the money in the traditional IRA. Once required minimum distributions start at age 73, those forced withdrawals push you into higher brackets, often the 22 or 24% range. The estimated tax savings from the conversion ladder, $50,000 to $80,000 over 20 years. That range depends on growth rate and future brackets, so it is a projection, not a guarantee. But the math is clear. Spreading conversions across low-income years almost always beats waiting. One more rule you need to know before you start converting. Each conversion has its own 5-year clock. If you withdraw the converted amount before 5 years and before age 59 and a half, you owe a 10% early withdrawal penalty on the converted amount, and even though you already paid income tax on it. IRS publication 590B is clear on this. So if you're under 59 and a half, factor the 5-year rule into your planning. There's also something new for 2026 that affects high earners still working. Starting this year, employees aged 50 and older who earned more than $145,000 in FICA wages must make their catch-up contributions to a 401k as Roth. They can no longer use pre-tax catch-up contributions. This comes from Secure Act 2.0, and it means more money is flowing into Roth accounts whether people planned for it or not. And here's the big picture reason Roth conversions matter so much. Roth IRAs have no required minimum distributions during the account owner's lifetime. Unlike traditional IRAs, you are never forced to withdraw from a Roth. That means you control the timing. You control the tax impact. And if you don't need the money, it passes to your heirs with decades of additional tax-free growth potential. For 2026, the Roth IRA direct contribution income phase-out is $153,000 to $168,000 for single filers, and $242,000 to $252,000 for married filing jointly. If you earn above those limits, you can't contribute directly to a Roth. But remember, there is no income limit on conversions. That's the back door. Let's also mention the SALT deduction change because it affects your conversion math. The One Big Beautiful Bill raised the SALT cap, that's the state and local tax deduction, from $10,000 to $40,000 for tax years 2025 through 2029. But it phases down for modified adjusted gross incomes above $500,000. If you're itemizing and live in a high tax state, this larger SALT deduction could create additional room in lower brackets for conversions. And one final number. For 2026, the IRA contribution limit is $7,500, up from $7,000. With the catch-up contribution of $1,100 for those age 50 and older, the total is $8,600. That's separate from conversions. You can contribute and convert in the same year. So here's your action plan. Step 1, figure out your taxable income for 2026 without any conversion. Step 2, look at the tax brackets and IRMA thresholds. Step 3, calculate how much room you have in your current bracket before you jump to the next one, or trigger an IRMA surcharge. Step 4, convert up to that amount and pay the tax from a taxable account if you can. Step 5, repeat every year during your retirement income valley. If you're not sure where to start with this calculation, we put together a breakdown of the full 2026 tax brackets and IRMA thresholds. Check the link in the description. Now that you understand how Roth conversions work, the next question is what happens when you're forced to take money out of your traditional accounts? Required minimum distributions. That's a topic we'll cover soon, and it connects directly to everything we talked about today. Subscribe so you don't miss it.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.